This video will describe the contents of the Lender's Report, one of 6 reports provided by the Fiscal Checkup software. The focus of this report is to present a complete financial analysis for a lender, but also to help a business see how a lender views the business from a creditworthiness perspective. The report starts with a company dashboard, graphically showing 6 important financial variables with some helpful explanations below the graphs. The first graph compares the profit margins for the company compared to their industry for the past 3 years. Related charts and information can be found in the Industry Comparables report. This chart shows how the profits from new or incremental sales compared to the old or base sales. The basis for calculating these values is explained in the profit driver report, but it's critical to understand the profitability of new sales versus old sales. Operating profit is the amount of money after cost of goods sold and operating expenses have been deducted from revenue or sales, but before other non-operating expenses have been deducted. Operating cash is the amount of cash from operations before other non-operating expenses. The 2 lines on this chart should be tracking together. When they don't, or there are wide variations, it's prudent to work with your CPA or business advisor to understand the reasons. For more information, see the Profit Driver report. This is simply the ratio of the amount of debt divided by the amount of equity on the balance sheet. This ratio varies by industry, so both the company data and the industry comparable data are presented. Additional debt is not necessarily bad as long as the net profit margin is greater than the interest rate on the debt, which means positive leverage, and that the debt service coverage ratio meets minimum standards. The growth rate in green is the growth rate of top-line revenues as seen on the company's income statement. The real growth rate represents the actual growth rate of the company after adjusting for price and cost of goods sold changes. The sustainable growth rate is the maximum growth rate that can be supported by the company's assets and margins. Any growth above the sustainable growth rate over the long term would require external financing. More information can be found in the Profit Driver report. This graph is a very important ratio that indicates the company's risk level. This ratio is the value of the future income stream of the company, also called the discounted cash flow, compared to the company's total liabilities. The narrative discusses the ratio of liabilities to the value of the company in more detail. This is an important ratio since it estimates the ability of the company to pay its liabilities with future cash flows. Page 2 contains the income statement, including adjustments to show the true earnings of the business. Page 2 starts with the standard income statement breakouts of sales, expenses, non-operating expenses, and profit. The table continues with other data important to lenders, such as the owner's excess compensation, accelerated depreciation, and the impact of the income statement adjustments that were entered as part of the business valuation. On the bottom of page 2 is a table showing year-over-year changes for the primary income statement categories. Page 3 presents the balance sheet. The first table creates a balance sheet using the data entered into Fiscal Checkup. On the bottom of the page is a table showing the year-over-year changes for the primary balance sheet categories. Page 4 takes the data entered into Fiscal Checkup and creates the UCA cash flow statement for the past 2 years in the format desired by most lenders. Page 5 provides a 3-year forecast of the business, including key income statement and balance sheet estimates, as well as outlining collateral quality, borrowing capacity, and the company's ability to repay their debt obligations. Above the forecast table, it always states whether the numbers in the table are based on the continuation of the past trends, otherwise known as the status quo, or based on new parameters. In a few slides, I will show you what it looks like when some of the parameters have been changed. The first 7 lines project what the income statement will look like through EBITDA. Lines 8 through 14 show the current portion of the balance sheet and cash after operations on line 14. Every business needs to first develop its operating forecast. That is why we only focus on the current asset and current liability portions of the balance sheet here. After any capital expenditures and the company's financing costs are deducted, the forecast shows the net surplus or cash needs of the business. Line 17, showing the cash surplus or needs, is a critical line for every business. It is wise to have an estimate of the cash generated, but it's essential to plan for any cash shortfall. In today's environment, companies can have a challenging time to secure funding. This is where the cash needs have to be developed so plans can begin to make sure the company has the ability to borrow any needed funds. The bottom half of the forecast table generates the collateral analysis for future loans. Fiscal Checkup reviews the revolving credit on short-term assets and the term credit on long-term assets, both of which are totaled on line 22, the total borrowing capacity of all the assets of the company. The existing debt is deducted to arrive at the available credit capacity on line 24. Lines 25 through 29 show key ratios that determine the bankability of the business. A company needs to have both the ability to borrow funds and the ability to repay the debt. On line 27, the debt service coverage ratio, which measures the company's ability to repay their loans, generally needs to be above 1.25 to secure financing from most lenders. Some lenders even want 1.5, which provides for a 50% cushion. For those businesses that borrow money based on the cash flow of the business, like a service-based business, line 29 estimates the borrowing capacity based on those parameters. The final line in the forecasting table shows how the value of the business will be impacted over the next 3 years based on the financial performance above. The bar chart shows the cash after operations, line 14 from the forecasting table, in graphic form. This bar chart shows the business value, line 30 from the forecasting table, in graphic form. Whenever you change parameters for the forecast, above the top of the forecast table, it specifies the changes that have been made. In this example, the cost of goods sold has been reduced to 67.6% from the company trend of 73%. The capital expenditures budget has been increased to 1.8% from the company trend of 1.28%. And the inventory days have been reduced to 96.6 days from the company trend of 107 days. These changes are reflected in all appropriate lines of the table below, including the final line of business value, so a company can quickly assess the impact of any proposed changes. Page 6 reviews certain key ratios. The first table shows key profitability, liquidity, activity, and financial ratios for the past 3 years. The bottom of the page shows the cash conversion cycle data, showing that this company is managing its cash better than their industry peers and showing their working capital is more than $125,000 higher than would be expected for a company of their size operating at the industry average. Below the table is a discussion of some of the ratios presented on this page, including a discussion of working capital, debt, equity, and the bankability of the business. Page 7 provides detailed industry comparable data. At the top of the page contains a table showing the selected income statement and balance sheet data from the company for the past 3 years with industry data in the far right column. The table on the bottom of the page shows many common financial ratios for the past year of the company compared to its industry in the far right column. Page 8 contains an analysis of sales and a summary of the business valuation. The first table on page 8 completes an analysis of what we call sales quality. From 2014 to 2015, sales increased by $816,000, but there was an operating loss of $11,000. The company needs to understand if the loss was due to poor margin control on the new sales versus changes in the ratios that drive profitability. It appears that one of the keys to the loss is cost of goods sold. The margin erosion for this account negatively impacted profitability by over $134,000. On the other hand, operating expenses as a percentage of sales improved, contributing over $100,000 in profitability. So when you net the loss of margin from cost of goods sold against the improvement in margin due to reduced operating expenses, the net negative impact of these two accounts was almost $33,000 in 2015, which means that the new sales actually contributed about $22,000 in profitability, which was able to reduce the overall operating loss. In fact, had this company not had these profitable sales, the loss would have been almost $33,000. A very similar analysis is calculated for the working capital accounts. Here, overall cash management due solely to ratio changes added over $93,000 in positive cash flow for this company. The improvements in receivables and inventory were used to pay their bills sooner. We can also see that the working capital used to fund the $816,000 increase in sales was over $188,000. This means that the $816,000 of new sales consumed $188,000 of cash. The same analysis is also included for the prior year. Finally, the business valuation is summarized on the bottom of the page. The fair market value listed on line 54 is the value with the balance sheet adjustments on line 55 and the value of the equity on line 56. Line 57 shows a valuation range of plus or minus 10% of the value that was listed on line 55. Page 9 will give business insight on how a lender will view them by showing many of the ratios that lenders use to evaluate loan applicants. Listed in the table at the top of the page are 8 of the most important objective risk ratings used by lenders. The table shows data for the company for the past 3 years and data for the industry for the most recent year. Comparing the values, the software calculates a rating for each ratio. If the company was exactly operating as the industry was, it would receive a rating of 6. The minimum rating is 1, the maximum rating is 10. To come up with an overall rating for the company, each variable is weighted as shown and a total rating is calculated. If, on average, the company was consistent with their industry, they would receive an average rating of 6. Below the table is an explanation of each ratio. For those ratios where the company is more than 10% above the industry, the title of the ratio is in green. For those ratios where the company is more than 10% below the industry, the titles are in red. And for those ratios where the company is within a plus or minus 10%, the title is in black. Page 10 presents a variance analysis on the financial statements, and it summarizes the V or viability rating. The analysis starts with the income statement. The software creates a hypothetical company of the same sales level, so we can see what expenses should be for a company of this size. For example, based on the industry averages, this company had $329,000 less expenses than would have been expected for a company of this size, a positive variance of almost 24%. An identical analysis is presented on the balance sheet. The software creates a hypothetical company of the same asset size, so it can show what the value of the selected balance sheet accounts should be for a company of this size. For example, based on the industry averages, this company had almost $188,000 less cash on hand than would have been expected for a company of this size, a negative variance of over 183%. The final section of this page summarizes the V or viability rating. In this case, the company scored a 57.12, a good rating. The V rating is comprised of 8 different variables known to predict the future viability of the company. The score for each variable is shown in the narrative. A more in-depth explanation of the V rating can be found in the video that describes the contents of the executive summary. For each report, there is the ability for the user or business advisor to add comments. If any were entered, they're listed on the final page of the report. Thank you for watching this video. If you have any questions or suggestions, please call or email us.